Good morning. It's great to be with you again. Another amazing month for markets in October, just a fantastic month. This market is really unstoppable. Every month, we're getting a consistent 2% return. Who could ask for anything more? Having a look across the various geographies and sectors, you can see that broadly, we had a risk-on month with very strong returns from the various categories. Strong markets all around and generally driven by some very exciting merger and acquisition news in the AI space, with OpenAI doing a number of deals, and I'm going to be talking about that in detail later. As a result, NVIDIA became the first company in the world to top $5 trillion in value. Just absolutely amazing. $5 trillion is hard to even fathom that size. We also had some fantastic results from the Magnificent Seven companies: Apple, Amazon, Alphabet, all the A's, getting an A+ on their report cards, and markets rewarding those companies, jumping between 5 and 10% each on those results. So as you can see on the chart, NASDAQ 100 doing very nicely for the month, up 5.3% in Rand terms. The FANG index up 5.2% for the month. So some strong tech results and some AI, M&A driving tech very, very nicely. Gold had a decent month, up 4.8%. But digital gold or Bitcoin down 4.5%. So the markets were whipsawed during the early of October, in fact, on the 10th of October, when Beijing tightened rare earth export restrictions. And as a result, Trump on a Friday evening said that he was going to put 100% tariffs on top of existing tariffs for China, and markets just collapsed. US equities were down 3.5%. But Bitcoin in particular had a huge fall. It fell from $125,000 to $102,000. That's more than 20% fall, wiping out $19 billion across 1.6 million traders. And apparently it was due to a lot of forced liquidations on holders of perpetual futures. Now, I understand derivatives quite well and futures, but a perpetual future is something that's very new to the markets, and certainly didn't work out too well for those holders on the 10th of October. But I thought what was more fascinating about this, Bitcoin did recover a bit before the end of the month, so only down 4.5%. But it was interesting to see on that day, so on Friday, the 10th of October, what rallied, who benefited when there was a true fear, when there was a proper risk off. And gold benefited, which was actually quite surprising. I thought gold wouldn't, because it just seems to rally on good news, but now it also rallied on the bad news. But the traditional safe havens also did well. So the dollar did well on that evening. The Japanese yen did well. US bonds rallied. So it was good to see that the traditional safe havens, even though there are concerns about the debasement trade and that dollar currency is extinct and you shouldn't hold bonds, it was good to see that on that extreme risk-off event, that the traditional safe havens still did quite nicely. Of course, markets rallied towards the end of the month as Xi and President Trump backtracked on those threats and then did an amazing deal towards the end of the month. And I'll also talk more about that when we get to the China sector. But emerging markets up 4%, Japanese markets up 3.9%. Japan's got a new prime minister, the first female prime minister in Japan's history. Some exciting things happening in Japan, but pretty much everything up for the month except for Bitcoin. China also struggled. That's MSCI China, which is very much tech heavy, and there was a bit of a pullback in Chinese technology shares. Just a retracement from very, very, very overbought levels, but still very, very strong year to date. So how does it reflect in the Sygnia funds? We can see the emerging market 50 ETF, the top performer for the month, up 7% in Rand terms, and that's despite China having a pullback. China making up about 1/5 of that fund, but we had very strong returns from other emerging markets, particularly Taiwan, which had a great month. And then NVIDIA's strong return, breaking the $5 trillion market cap, that drove FANG up into second place, that's 6.3%. And the Fourth Industrial Revolution Fund moved into third place, 5.7%. Great to see the Fourth IR Fund up nicely. We haven't seen it there for a while. The South African property stocks also did very nicely for the month. That was on the back of lower bond yields in South Africa, as foreigners have finally, after a 3-year hiatus, have started buying South African bonds. And I'll also talk more about that on the South African section, some interesting things on SA and our bonds. And then finally, in the top five, squeezing in to the fifth position is the Sygnia Health Innovation Fund. Fantastic to see healthcare in the top five. And that was on the back of the US government and Pfizer deal. And I'm going to be talking more about that at the end of the webinar, just as a time to start nibbling at healthcare. And that Pfizer deal, at least providing some certainty, even though they agreed to lower drug prices, the threat of tariffs has been removed on their import compounds. So that gave some certainty to the sector, and it rallied as a result. Over 12 months, things looking very much the same, but very, very close returns. You can see at 38.6, 38.3, 36.7, so some very strong and highly correlated returns from either EM tech or US tech. And then in fourth and fifth position, we have SA top 40, and that's on the back of Naspers and Process being Chinese technology and gold, with nearly 30% of that top 40 being exposed to gold and platinum shares. So very, very nice returns over the 12-month period. So a great October, following on the heels of a great September, and hopefully it will last.
Yeah, that's a good question. Today is a very big day in terms of what we're doing. And look, these are tremendous sanctions. These are very big. Those are against their two big oil companies.
So some tremendous sanctions from Trump, some fantastic sanctions from Trump. But the bad news is that on the news of these fantastic sanctions, oil rallied 5%. And that certainly can have a big inflationary impact. And I'll show you a chart on the next slide. But what is just amazing in terms of how quickly Trump moves, just 1 week before he announced these sanctions on Russia, he had Zelensky in the White House, in the Oval Office, and he said to him that if he doesn't surrender the entire Donbas region to Putin, Putin will destroy him. So very strong words. And then the next week, sanctions on Russia. So hard to keep up, but certainly for the first time since Trump returned to the White House in his second term, we now have sanctions on Russia. And on the same day, EU also announced sanctions on Russia. They announced a complete ban of Russian LNG imports from 2027. That's the first complete ban on liquid natural gas ever on the EU to Russia. Not only that, but they also announced sanctions on 2 Russian companies and added another 117 ships from the oil shadow fleet to that blacklist. So some strong sanctions from the US and EU on Russian companies and Russian oil. And then just shortly after that, Trump then confirmed that the US had canceled all trade negotiations with Canada, and that pushed oil prices up even further because the US does still import some oil from Canada. Of course, he could very easily switch those or cancel the cancellation of trade deals tomorrow. So that's not having a big impact. But overall, the sanctions has pushed up the oil price. Now, if you look at the charts on the right here, you can see in the green line, that's the oil price, and it rallied from about $61 to $66 a barrel, and that pushed up the 10 years. I mean, this is long-term inflation expectations, 10-year US inflation expectations. You can see the very strong correlation between the oil price and inflation. So even though we've had some tariff inflation, what's kept inflation expectations low is the fact that oil price is much lower than the start of the year. You can see that towards the beginning of 2025, oil was sitting at about $80 a barrel, and now it's at 66. And that low oil price has certainly helped mitigate any inflation tariff impacts. But if the oil price rises, well, that's a big risk. Not only that, but a Department of Labor report estimates that 42% of US agricultural workers may be unable to enter the US because they will be subject to removal by ICE, immigration control. And that could have a huge impact on US food inflation. Suddenly, either those farms have to hire local workers at a much higher price, or they've got to mechanize and buy a lot of capital equipment. Either way, it's going to lead to much more expensive food for US consumers. Now, food inflation has a much bigger impact on US consumers' inflation expectations, which is what the Fed watches. So this could be a big impact. Not only that, but the Fed watches that number very closely. And Trump is unlikely to unwind his immigration policies. I mean, that's one of the pillars of his second term is making America great again, getting rid of immigrants, and that means 42% of agricultural workers won't be returning to the US this year. That's quite something. Having a look at actual inflation, we had inflation come out despite the US being closed. There's a chance it's not going to come out next month, but it did come out last month, and that's actually still looking quite sticky. We had super core inflation, which is services inflation less shelter, because shelter is quite lagging. Home prices tend to lag by about 6 to 9 months. And that's close to 0.4% for the third month. 0.4 multiplied by 12, you're sitting at close to 5% services inflation in the US. So it's hard to say there's no inflation in the US. There is inflation. Plus you've got higher oil prices. Plus you've got the fact that food inflation could be going higher. Despite that, the Fed did cut rates for the second time this year in October. So they cut by 25 basis points to the 3.75 to 4% range, which markets expected. However, what markets didn't expect was that Jeremy Powell was quite clear, in fact, very adamant, that although the dot plot forecasts, the FOMC forecasts another cut in December, it's not guaranteed. In fact, he said, a further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. And that saw the dollar rally, it saw the gold price come off, it saw the rand weaken, and all that unwinding of excess liquidity has seen a small blip in the risk-on story. So we've been watching that very closely, because if that takes hold, we may need to move into a more cautious position and cut our overweights, and particularly cut our EM position. So we're going to be watching that very closely. But for now, the rally that continues, it's all about US technology. And that was all thanks to this guy, Sam Altman, Chief Executive Officer of OpenAI. I'm sure you've all heard about him, but he had a very busy October and announced a series of unprecedented infrastructure deals, committing to more than 26 gigawatts of computing capacity. And that's across Oracle, NVIDIA, AMD, Broadcom, representing over $1 trillion in spending commitments over the next decade. And that was before he even later on announced a further deal of $250 billion with Microsoft's Azure. This is just staggering amounts, $1.25 trillion. And that's, the power requirements alone for that would need 26 additional nuclear reactors in the US. So the power requirements for this infrastructure boom is just absolutely staggering. Now, this is all from a company that, so we've got $1.25 trillion that's been committed. That's what they're going to spend over the next decade. With $13 billion of revenue over the last year and an $8 billion loss over the last 6 months. And you can see here his Sam Altman, that was at his interview, he says, profitability is not in my top 10 concerns. So it is a bit concerning because the market is rallying massively because all the listed companies, Oracle, NVIDIA, AMD, Broadcom, Qualcomm, Microsoft, they're all getting incredibly excited because of this huge addition to revenue that they can now see over the next 10 years. The issue is the person or the company that's going to be spending, well, there's no certainty as to how they're actually going to get the money to pay for that. So very much, I'd have to say that it's all about the market seems to be believing in the Field of Dreams business school. And that's the, if they build it, they will come. So I'm not too sure I believe in the Field of Dreams business school. It's certainly what the market is believing right now. And that's why we've had such amazing returns in the technology sector, because of all these forecast revenue boosts from the $1.25 trillion that is being spent. Now, to put that in context, that's going forward. But even looking back, the amount of spending that's happening by the hyperscalers is just also unprecedented. It's nearly 4 times what it was 3 years ago. So if you look at the chart on the right, you can see that the technology investment, in terms of its contribution to US GDP, has reached the highest level ever. To put that into scale, over the last year, normally tech investment's about 4.5% of GDP. That tech investment, that only 4.5% of GDP, has contributed nearly as much to the growth of the US as consumer spending. And consumer spending is 68% of the economy. So it's got more than 10 times the impact. So AI infrastructure spend is one of the largest drivers of growth. It's certainly the largest capital deployment cycle we've ever seen in the tech industry. You can see that it's even larger than the impact in Y2K, when we had the last technology bubble. And it's not only impacting semiconductors like NVIDIA, but it's now impacting property developers and obviously power generation. I mean, you need to build an extra 30 nuclear power stations. There's a lot of power demand. But the risk is that the business model behind the hyperscalers, the Magnificent Seven, it's always been that they're fantastic business models. These are companies that are capital light, and you just have a platform. It's very easy to add clients. It's very easy to add new services. It all costs you very little, and you just roll out new clients, new services, new clients, and you print money. But these hyperscalers are now starting to resemble infrastructure builders with huge capex. And the Mag 7's Q3 1-year trailing capex is estimated at going to be $400 billion. As I said, that's 3 times higher than it was 2 years ago. Now, the question is, that's great, because right now the market is getting very excited and it's buoyant because of all the spend that's happening now and all the forecast spend over the next decade. But the question is, how are these companies going to monetize that spend? How are they going to get a return on investment? Fortunately, that's tomorrow's concern. It's definitely something that I'm concerned about, and it's keeping me up at night. It's why we don't have an overweight to the FANG stocks, but we also aren't underweight, and we're neutral the US. Because for now, CapEx is in the driver's seat, and every day there's new announcements of new CapEx, and the market's just, well, people are spending, so that's great. But the question is, at some point, you're going to have to get a return on that spend, and then there could be some big disappointments when it comes to the market. But for now, CapEx is in the share price driver. So we are watching this boom continue. We're definitely in a bubble, but bubbles can get more inflated. Bubbles can last for quite some time. There was some interesting work done by Alpine Macro. They estimate that if we are in a bubble compared to Y2K, we're about a year before the Y2K peak. I don't think the bubble is going to run for as much as 12 months, but they say it can very easily run for another 12 months based on the previous example. So we're watching very cautiously, we're watching very closely, but we still remain overweight global equities. We are overweight EM, but within the developed markets, we do have exposure to the US, neutral US, Europe, and Japan.
They will threaten us with rare earths. I don't think they're threatening us too much right now, but they could do that. But I threaten them with something I think is much more powerful, and that's tariff. So I think we're going to end up having a fantastic deal with China. It's going to be a great trade deal. It's going to be fantastic for both countries, and it's going to be fantastic for the entire world.
So Trump forecasting a fantastic deal, a great deal. After the deal, he said it was an amazing meeting. In fact, he said it was 12 out of 10, which just sounds brilliant. However, China is definitely winning the trade war with the US without even fighting. So the results of this huge blip that we saw in the markets, or hardly a blip when it comes to Bitcoin, down 20%, but other markets fell 3.5% and then recovered. But the result of all that US-China trade tensions was that the US cut tariffs. So cut the fentanyl tariff from 20% to 10%. So they halved the tariffs to China. And all that China did was paused their restrictions on rare earth exports for a year. So China definitely seems to be taking the upper hand of the US-China trade conflict. Now, looking at China, they had a fantastic and amazing 6 months. Exports surged the most in September that they have in quite some time. And that's despite exports to the US declining 27% because their exports as a whole, despite falling by 27% to the US, China's exports as a whole reached a new high. And exports contributed 1.2% of China's 4.8% GDP growth in Q3, which beat expectations. So China growth looking strong. And it's not just the GDP numbers that are showing China's resilience, but their commodity imports were just also phenomenal in September. Gold imports rose to a 5-month high. Palladium imports were 6 times higher than a year ago. Refined copper also reached a year-to-date high. So things are moving along swiftly in China. Now, I thought the chart on the right was quite fascinating because China is getting a lot of flack because of their trade surpluses. They are exporting goods at reduced prices to the rest of the world. They're being accused of dumping. But Chinese export contribution to GDP is only 20%. So only 20% of their GDP is from exports. And if you look at the chart on the right, you can see China in the dark green. It's actually second from the bottom. The only country that has a lower dependence on exports is the US at about 10%. And at 20%, it sits around Japan and India, but way below Germany and South Korea. Europe far more dependent on exports than China is. But China still gets a lot of flack because of the scope of the exports. It might only be 20% of their GDP, but on a global scale, it is quite a large volume. And the other constant headwind that China faces is that private consumption remains subdued. So it wasn't very surprising that China's 15th five-year plan, so that's their strategic blueprint for the next 5 years, 2026 to 2030, they continued the shift, moving from export-focused growth to inward-focused domestic consumption. And how are they going to achieve more domestic consumption? Well, they're going to improve social welfare. That's very, very important. I mean, that's probably the key thing that needs to happen in China so that Chinese consumers have more confidence. They can rely on the social welfare system. And as a result, they don't have to hold as much savings and they can spend. Also, rural revitalization, very important. And then because of the trade wars, increased technology self-reliance and diversifying their trade partners and less dependence on critical material imports. So China very much focusing inward for the next 5 years and continuing to be a pillar of growth for emerging markets and why we remain overweight emerging markets because of this huge policy stimulus that we're seeing within China that continues to drive their GDP, despite obviously some issues that they are facing domestically. Okay, moving on to South Africa, some very interesting comments from the governor of the SARB saying that the SARB might opportunistically take advantage of cheap dollars to build FX reserves if the ZAR gets uncomfortably strong. Basically saying that, the South African government is going to intervene in our currency if the rand gets below 17, as they think that will make our exports uncompetitive. So we could see some support to the rand. In fact, it might put a floor to the rand at 17. So it'll be very interesting to watch that. But any people who are expecting a lot of rand strength on the back of the very high gold price and the very high copper price and the very high palladium and platinum prices, well, the SARB might be putting a floor under that strength. And so that's something that we'll be watching quite closely. Now, we have the budget coming up on the 12th of November, the South African medium-term budget policy statement. And the market is expecting a fantastic budget, a great budget, an amazing budget. We think the budget's not going to be as good as expected. Sure, decent. But the reasons it's going to be decent are not really something that we can be proud of or think that's sustainable. So tax receipts will be higher because of the commodity windfall, but we don't know how long the commodity windfall is going to last. Tax receipts will also be higher than expected because there's been reduced VAT repayments. So that has to normalize. On the expenditure side, that's also going to be lower than expected, But that's because there was a delay to the budget, as you all know. We had to wait for budget 3.0 before we could start spending. So that has kept our expenses lower, but that's also going to normalize. And then there was some good support to lower interest cost because of lower inflation and the strong rand. And that has allowed our interest expense to stabilize. But you're not falling, just stabilizing. So overall, we think this could be a decent budget. But the impacts we're going to see now in October probably won't feed through as much in February as that unwinds. Not only that, but significant event risk remains. So the chart on the right shows the government guarantees to the various state-owned enterprises. And you can see in the dark green Transnet that was added at the last budget, not at the last budget, but the day after the budget. So we had an okay budget 3.0, and then the next day, it was announced that there was this huge guarantee to Transnet. So we could see more government guarantees. That's clearly the forecast is for it to fall, but if you look at the last decade, that forecast has not fallen, just as our debt to GDP has not fallen. Now, there are some good news data points. We finally, the Financial Action Task Force has removed South Africa and Nigeria from the grey list. So that hopefully will help life become a little bit easier than it was. And there are rumors that South Africa's credit rating might be upgraded. Now, I think it's important to realize that it does depend on which rating agency you're looking at, but S&P has us on BB minus. So sure, they might upgrade us to BB plus. Oh, sorry, they might upgrade us to BB, and then they might upgrade us twice to BB plus, but we need 3 notches to be upgraded to investment grade. And I can't see that happening anytime soon. So yes, we might get upgraded, but investment grade is something that we're very far from. The average debt to GDP of emerging markets at investment grade is about 40 to 50%. Our debt to GDP is in the high 70s, and RMB forecasts our debt to GDP is actually going to only peak in 2027, 2028 at 80%. And that continues the trend we've seen for the last decade. Every year we have a forecast. Yes, our debt's going to consolidate in 2 years' time, and every year it gets pushed out and gets pushed out and gets pushed out. Now, the reasons it gets pushed out is that our growth is just too low. When you're growing at 1%, you can't create employment. You can't grow out of your debt. The maths won't allow you to do it. The numbers, it's just physically impossible to reduce your debt levels when you grow at 1%. So we need to grow more. This is something I've spoken about before, but we still have structural constraints to our growth. So until we see those structural constraints change, until those reforms happen, we're not changing our view of being structurally underweight South Africa. At the moment, we are overweight South African equities tactically because of the commodity price boom and resources, and we're overweight South African bonds, because we do think we're going to get a good budget. But we are quite nervous about our South African bond position because our South African bond prices are pricing in almost perfection, and we still have a lot of risks out there. Not only is there the risk of the SOE guarantees being extended, but we have the COVID-19 Social Relief or Distress Grant, which is not currently in the budget. So if that gets extended, I doubt they'll mention it now in October, but if that is extended in February next year, well, we've got to find another 30 billion rand to cover that just for that year. So there's a lot of details that keep us cautious, and we might even be downgrading SA bonds quite soon, and because of the strong rally that they have had. So we're watching this very, very closely. Okay, let's move on to positioning before I touch on healthcare. Okay, so we had the IMF come out with their updated growth forecast. They have upgraded growth in 2025. So this year's growth being upgraded from 3% to 3.2%. That's not great growth, but it is, so it's not above trend, but at least it's not recessionary. So it's just, we are sputtering along. And they attribute that higher growth to the front running of tariffs that we've seen across the world, as well as the AI capex boom. So that's good news. However, they are downgrading next year's growth down to 3.1% on the back of a slower growth due to normalization of the tariff trade front running and the higher inflation that's going to come into the US because of those tariffs. And not only the tariffs, but we might see inflation come through because of the immigration policies, which impact food prices or other inflation like sticky core services that we are seeing. And IMF chief economist says it's not as bad as we feared. But it's worse than we anticipated a year ago, and it's worse than we need. So yes, things are not recessionary, which is why we are still overweight, but they're certainly not amazing, and they're not fantastic, and they're not great. And the markets are pricing in quite a Goldilocks scenario. So we remain very cautious. And in fact, because of the volatility we've seen in October, we are getting very nervous. So volatility tends to spike at market tops. When prices are elevated, you get a lot of big swings. And we saw certainly some huge swings in SA equity prices and in gold prices in the month of October. And that volatility could indicate that we are at a market top. But for now, even though we are concerned with this volatility, we are not fighting the Fed, and the Fed did cut rates this was past month in October. And so while the Fed is supporting the markets, we continue to be overweight. So no change to our views there. Momentum remains strong, and we are continue to position for a weaker dollar and strong markets. But if the Fed doesn't cut in December, or we start to see some inflation come through, well, we might cut sooner than expected, or just the volatility hits some of our stop losses, well, we could also change that position quite quickly. But for now, despite the risks, and there are a lot of risks out there. I mean, we saw the US regional banking crisis that happened this month, with some sharp slow falls in some of the regional US banks, which gave us kind of echoes of the Silicon Valley crashes. The US government is still shut down, and the Congressional Budget Office estimate that so far it's cost the US economy $18 billion. So that could continue, and that could see risks as well. The Russia-Ukraine war is only going to heat up with the additional sanctions that are being put in place by the US and Russia. So we've got a lot of risks that are growing, and we've got volatility that's rising, and we could have some big pullbacks in the market. But for now, we are positioning the same as we have, not fighting the Fed, staying long markets. But another factor that we are watching is the chart on the right, and that just shows again the leverage that we're seeing in the US. So the US consumers have the highest exposure to equities relative to their property and cash savings in the history of the US. Not only that, so they've got a lot more equities than they've had in the past, but the exposure based on leverage. So this chart shows US margin accounts balances divided by US GDP. You can see there we're sitting at all-time highs in terms of margin balances relative to US GDP. So it's not only are US households exposed more than ever, but there's a lot of speculation happening, trying to get upside from these markets. So that could unwind very, very quickly if markets fall, as the stop losses on those margin accounts have force very, very rapid unwinds. Possibly not as rapid as perpetual futures, but any futures, any leveraged position, you're sitting with 10% margin. If the market falls, you very, very, very quickly run out of margin. And if you can't post more margin, you're forced to unwind, and that could lead to quite a decent pullback, even if we're not seeing a recession anytime soon in the US or the rest of the world. So overall, our positioning remains the same, although we are getting increasingly concerned about the heightened volatility. Okay, final slide for today, just having a quick look at the healthcare sector. So the healthcare sector has been an abysmal performer. There's no doubt about that. It's certainly one of the worst performing sectors over the last year, even last 2 or 3 years. But as you saw earlier, it had a great October. And the chart on the right, you can see that the blue line is the price. So the price did pick up quite nicely. Why? Why did we see this bounce in the healthcare sector over the month of October? Well, firstly, as I mentioned, we had the landmark Pfizer US government deal. Now, certainly over since Trump came into power, tariff concerns on the import compounds for US drug manufacturers has been a big concern. Price regulation threats has been a big concern. And this Pfizer deal, although it confirms that prices will remain low, it removes uncertainty. And markets like certainty. So certainly the Pfizer US deal is a step in the right direction that will allow the US healthcare sector to recover. So that's one good point. The second point is that over the last year, US drug companies that are called compounders, we refer to them as generics, but they refer to them as compounders. And what happens in the US is if there's a shortage of a particular FDA-approved company, compounders are allowed to sell the generic even if it's not FDA approved. Sounds a bit risky, but that's what's been happening over the last year, and that's had a huge impact on the semaglutide drugs like Ozempic and Wegovy, and those are top 3, top 5 companies in the healthcare sector. So those companies have come off 50% for a variety of reasons, but the shortages did end in the second quarter of 2025, and so that will allow these companies to start selling larger volumes at higher prices, and that should see some margin recovery. So that's the second point. One, tariffs are out of the way. Two, we're not going to have unlicensed drug selling keeping margins low. Three, Berkshire Hathaway, they opened a new stake in United Health. And when Berkshire Hathaway buys something, the market tends to get a bit more confidence about the sector. So that also helped the sector bounce. Then looking more long term, when it comes to valuation, and this is certainly not a catalyst, but it does help the long term investors. The healthcare sector is very cheap relative to its own history, and also very cheap compared to the overall market. So it's trading at a discount to itself, and it's trading at a discount to the market. So possibly a good time to enter. And then the fifth point, which I have stated numerous times, but it hasn't helped you over the last 3 years, is that the healthcare sector is expected to grow at twice. So that's the revenue. Revenue in the healthcare sector is expected to grow at twice the national GDP over the long term because of aging populations and drug innovations. So it's a nice defensive place to be. However, so 5 good reasons. You can see that the price has rallied quite nicely. We're not getting involved just yet. And the reason we're not is because the earnings have not seen upgrades yet. So that's the green line. And the green line shows the 4Q 2025 consensus earnings. So a lot of people use these earnings revisions as a catalyst to get excited about companies or to get entry points, and that has not turned. Those earnings continue to fall. So when we see a turning point or at least a stabilization of those earnings, we might actually open up a position. But we haven't. The second point is that there's just currently no flows because investors have shifted into the AI sector. They're chasing growth. They're chasing either AI directly or they're chasing property stocks that are benefiting from AI or energy stocks that are benefiting from AI because growth is sitting at such strong levels. I mean, right now, the Atlanta Fed GDP forecast for 4Q GDP in the US is at 4%. So investors are investing into cyclical sectors and they're not investing in the traditional safe havens, the defensive sectors like healthcare, like consumer staples, like telcos. And as a result, there's just no flows to sustainably push up the sector. So for those 2 reasons, 1, we're not seeing an earnings bounce, and 2, from a macro top-down perspective, the momentum is still behind the cyclicals and not the defensives. We're holding back a bit. That said, if you're a long-term investor, the sector is cheap, and it definitely is not a bad idea to start nibbling to get in at these levels. You might be very early, but you could also be right. You could also be at the bottom. Who knows when we start to see a change in the macro side or in the earnings revisions. But for now, we are holding back. Perfect. That is me for today. Let's see if we have any questions. Okay, a question from Chris. He says, apart from AI, the demands on America's electrical infrastructure are enormous, e.g. the EV rollout, and what about Bitcoin's energy sapping requirements? The big question, apart from where our earnings coming from, is who's going to pay for the new electrical infrastructure? Chris, you are spot on, and that is why people are getting excited about the US energy sector, is that not only are there huge energy requirements from the green rollout, from Bitcoin, from AI, but there's a massive shortage or constraint on their backbone infrastructure, their transmission network. They just don't have the ability, just like South Africa, they don't have the ability to move electricity from one point to another point, and particularly if they want to roll out solar panels and other more green technologies, they have some big issues. So yeah, there is definitely a backlog and a shortfall, and that could see some strong demand for energy infrastructure, as well as property developers, and that sector. Next question. Tracy says, what is your view on AI and the labor market? Are you in the camp that AI replaces workers, or that the labor market is shrinking and we have an aging workforce and therefore this is not much of an issue as people seem to believe? Tracy, that's a very, very, very topical question right now. So the US is actually being saved to an extent by Trump's immigration policy. So it's expected that the US immigrants will fall by, or we'll see about a reduction of about 1 million people from the US labor force because of immigration, forced immigration. So that's labor supply falling by at least 1 million people. At the same time, demand is also slowing because of the shift to AI. And that has allowed the equilibrium level of employment to be close to about zero. So that's why we're not seeing much demand growth happening to employment, or there's not much employment growth, but the unemployment rate is not ticking up much. So overall, at a high level, yes, the shrinking labor supply is balancing the lack of demand because of AI. The problem is that the workers that you are not getting in the labor force are different to the workers that you need to support your AI growth. So we're seeing a big mismatch in the demand and supply of labor, and that's going to lead to wage inflation across the spectrum. And that could be a big issue for the Fed, where they see the stagflation of falling employment but rising wages. And what do they do at that point? Do they raise rates? Do they cut rates? If anything, maybe it just means that they don't cut as much, but the market's not going to like that. So there is a big concern right now about the US labor force. Certainly, it's not looking recessionary, but it's slowing. And it's okay for now if it doesn't lead to inflation. But if it leads to inflation, we could have some big shocks in the US. Mike says, in a previous webinar, you said the skeleton range of funds should not return negative for more than 2 years. Is that correct? Mike, I think you're thinking about the skeleton balanced range. We have skeleton balance 70, which is 70% equities, skeleton balance 60, which is 60% equities, skeleton balance 40, which is 40% equities, and then skeleton balanced absolute. The skeleton balanced absolute fund is about 20% equities, and that fund has a dual target. It's an absolute return fund. It targets real returns over the medium term, but over every rolling 12-month period, it targets no negative returns. So if you're looking for a fund that has a more absolute focus, some downside protection, it's a skeleton balanced absolute fund. It's been growing very nicely over the last 12 months. We only launched it about 18 months ago, but it's been getting some very nice flows, and performance has been good as well. Julian says, are you concerned about a possible US stagflation, and how would one prepare clients' portfolios for that type of scenario? As far as I can see things, tariffs have raised prices and AI will be reducing employment. Julian, I think that follows on very nicely from Tracy's question. So the markets are definitely not pricing any type of stagflation. We've got a number of long short baskets that are put out by Goldman Sachs and other banks, which price stagflation winners to stagflation losers. or tariff winners to tariff losers. And those baskets are not pricing in any tariff inflation, not pricing in any stagflation. The market's 100% behind the AI boom. It's all about cyclicals. It's all about strong growth. As I said, the Atlanta Fed GDP is sitting at 4% forecast return. So right now, the last thing that anybody is concerned about is US stagflation. And so we also are not positioning for that just yet, because this boom could continue for a little bit longer. However, if you want to position yourself for US stagflation, you need to invest in more defensive US stocks or US sectors. That would be healthcare, telcos, staples, US staples. So from the Sygnia fund range, that would be the Health Innovation Fund, would definitely benefit in a stagflation environment. The Berkshire Hathaway Fund would also do very nicely in a stagflation environment. Berkshire Hathaway is seen as a far more defensive company. That's why its share price has lagged the market. I mean, they came out with amazing, great, fantastic numbers on Saturday, but the share price fell. Why? Well, because it's seen as boring and defensive. It's got a huge amount of cash on the balance sheet. It's got very, very stable defensive companies. It'll continue to tick along, but it's not going to race up with the current AI M&A excitement that sees shares run 30% in a day because of deals with OpenAI. So health innovation would be one. Berkshire Hathaway would be another one. Dollar cash would also do very well in the US stagflation environment. You'd expect the rand to weaken, because in a stagflation environment, the Fed would have to cut less than expected, or hike even, which would mean a stronger dollar, a weaker rand, weaker emerging markets. So you'd want very much a more dollar-focused portfolio. Dollar cash, telcos, healthcare, Berkshire Hathaway could all do quite nicely in a stagflation environment. Troy says, have you increased your tactical exposure to Europe, Asia, including Japan and EM, and by how much? Troy, we are still overweight emerging markets, emerging market equities, and emerging market bonds. We haven't increased that exposure over the last month. As I said, we are debating whether we should be cutting SA bonds, but we haven't made any changes to EM equities or SA equities or EM bonds. We also haven't done anything to our DM exposure. So we're underweight developed market equities, but that's neutral across Europe, Asia, Japan, and the US. So no changes there. Serena says, if long-term investors have been invested for the last 2 years in Sygnia Healthcare Fund, given all your input, what would one hold on? Was going to move a portion to Emerging Market 50 Fund, faith in healthcare as a sector diminished. Serena, you're spot on. We have seen a lot of long-term investors in the healthcare fund reach capitulation levels, reach exhaustion levels. They don't know how long it's going to be before the healthcare sector bounces, and so they've switched out of the healthcare sector into something more cyclical, something more exciting, something that's doing better, and then when the cycle turns, they'll switch back. So you could do that. I've just pointed out 5 good reasons why you could start nibbling the healthcare sector, even if it's too early. So, if you've held on for 2 years, I would probably hold on a little bit longer, because I think we are getting close to a buying opportunity in healthcare, if we're not there yet or already. And it would be terrible to sell, have waited 2 years, sell tomorrow, and then suddenly the macro environment changes or earnings revisions start to tick up, and you've got to move back to a month later. Yeah. Trevin says SIGP has been performing poorly, as have all property type stocks. What is the outlook for the sector from Sygnia's perspective? Trevin, you're spot on. So the Sygnia Global Real Estate ITRIX ETF hasn't done very well. Global real estate hasn't done well. SA property has done incredibly well because of our falling bond yields. But global property, because of rising bond yields, has also struggled. So it all depends on your outlook for property. I suppose property is something that will also do well if we see interest rates cut more than expected, or even in line with expectations. But if we start to see a stagflation environment come, which means higher bond yields, well, then the property sector is going to continue to underperform. We remain underweight global property. It's been one of our long-term underweights, and it's worked very well for our global funds. So our global portfolios have been underweight global property. In fact, we have a zero exposure on global property, and underweight global bonds, developed market bonds, and those two underweights continue to do very, very well in the current positioning. So yeah, we remain underweight those, and if we had a stagflation environment, we probably will remain underweight those sectors. The only time we'd want to switch into global property and global bonds is if we start looking like we're heading towards a recession. And that recession means that inflation falls as well. So if we start to see inflation fall dramatically and growth fall dramatically towards recessionary levels, well, then we might look to that position. But for the moment, nothing, no views there yet. Excuse me. When Renier says, looking at valuations across US markets and the way the markets keep on rallying, it almost feels like this will never end. Certainly, it does feel like this will never end. And it's been an amazing place to be over the last couple of years, but certainly year to date. However, history has shown we will see some sort of correction in the market. Also, spot on, markets do always correct. It is almost certainty. Yes, Renier, it is. Where do you think the market could be stretched and lead to potential big correction? So I'd have to say that I see the market's currently stretched in the AI space, definitely stretched. We're definitely in a bubble. When you have companies rallying 30% on one day, that sort of volatility is not sustainable and does mean that things are getting a bit euphoric, possibly stretched. On the other side, when it comes to the debasement trade, while the debasement trade is a long-term structural theme, I think it's also in the short term is stretched. I think gold is in a bubble. Again, these are bubbles that could continue for quite some time. So we remain positioned for the bubble to continue growing, but because you don't know when the bubble is going to burst. I've been worried about the gold price bubble and the AI bubble for the last 6 months. But we haven't positioned for that concern because markets climb a wall of worry, and it's impossible to pick market tops or market bottoms. So we're not positioning for correction yet, but we have stop losses that we will use if markets do correct. And the big question will be, if we see a correction, do we buy back into a correction if it falls 5%, or is that a concern for bigger things? Right now, the view is that if there's a 5% pullback, well, you just buy it. But you never know what the cause of that correction is, and it could cause a more strategic shift to stagflation, for example. So you're right, markets are stretched, markets are in bubble territory, particularly US technology stocks and gold stocks or precious metal stocks. But it's very difficult to predict when that correction is going to happen. And just talking to clients, and I think this is a good example of a data point that shows that we are in a bubble, is that right now people are very concerned about valuations, but they're more concerned about missing out on the upside. So when you've got that fear, but the greed is overriding that fear. And when greed is as high as it is now, well, that's certainly a sign of a bubble. Of course, it's hard to say how much longer that bubble will continue for. Good question. John says, do you see the rand continuing to strengthen against the US dollar, and how do you see that impacting growth in the Sygnia offshore funds? John, that's a great question. So we're still bullish on EM. We still think the dollar will weaken, that the current trend will continue. A stagflation environment would change that view, but we are less excited about the rand than other emerging markets. Now, the reason for that is twofold. One, the rest of the emerging markets are continuing to see inflation fall. Falling inflation in other EMs allows central banks to cut rates, and that sees further currency strength and growth as that falling interest rates stimulate the market. South Africa, on the other hand, we've seen our inflation pick up in the last month. Still pretty low, but it's picked up from 3% to 3.4%. We're an anomaly. We're actually going up in inflation, whereas the rest of the world is falling, or the rest of the emerging markets are falling. And that's because of our electricity prices and our water prices, which we can't control. It comes back to the structural issues of South Africa. So that's one reason that we don't like the rand compared to emerging markets. The second is that we might see our government trying to support the rand from strengthening too much. So that's that's not being said in other EMs. And then thirdly, my big issue is that other EMs are growing at 4, 5, 6, 7%. We're growing at 1%. So they can afford to be expensive. We can't afford to be expensive or we shouldn't be, because we can't pay down our debt to GDP. We can't pay down our debt with that low growth. So I don't think the rand's going to strengthen significantly against the dollar. To sum up my answer, it might touch 17, but I think that we're probably going to move sideways. If other EMs continue to rally, well, then we'll just move sideways. We won't strengthen like other EMs. And if we see stagflation, well, then all EMs and the rand would weaken quite significantly from those levels. Josh says, what is the reason for the skeleton international equity fund of funds apparent underperformance? Is this likely to change in the near future? The skeleton international equity fund of funds should be performing exactly on benchmark. It's currently, well, at least for the last 6 months, it's been on benchmark. It's sitting at benchmark weight EM, at benchmark weight US, Japan, and Europe. So that fund should be sitting on benchmark, as we don't have any active positions in that fund. Our overweight emerging markets and our overweight South African equities and bonds is in our balanced funds. Tando says, do you think organizations are looking into integrating AI with human labor to avoid increased unemployment? Certainly. There's definitely a vast move right now to integrate AI as much as possible into processes to reduce employment, to try and keep costs down, because the US in particular are very worried about the tariff inflation. So these companies are seeing this tariff inflation coming, they're seeing this margin squeeze coming, and they're scrambling to try and cut the labor force to save costs to meet that. So the irony is that Trump's "Let's Make America Great Again" by tariffs to help US manufacturing is actually leading to mass layoffs in the services industry, as the services try and combat inflation. So it's not looking great. But as I said earlier, for now, that's being balanced by lower immigration. So we're not seeing a tick up in the unemployment. So we'll see how that goes. Pleasure, Julian. Mandy says, hi, so on AI, what do you think of the Amazon deal that was announced yesterday of $38 billion with OpenAI involving NVIDIA and Oracle for the next 7 years? Mandy, you're spot on. So I spoke about $1 trillion of OpenAI deals before the Microsoft deal of $250 billion, and now yesterday's NVIDIA deal of another $40 billion. So we're now at $1.3 trillion over the next decade from a company that's making a loss that has $13 billion in revenue. So the question is, how is this company going to pay for all of this? Now, there was a big announcement where they have restructured OpenAI to partially be a for-profit company, because until now it was mostly a non-profit company. Microsoft has got a 27% stake in that company, and OpenAI is valued at $500 billion, even though it's making a loss. So they have 27% of that. Of course, the devil's in the detail, and it's very interesting to see that one of the things that the spend is for. I mean, OpenAI is spending this $1.3 trillion in the search for the Holy Grail, which is artificial generalized intelligence, AGI. And if they do achieve that, well, then maybe they will be able to pay back some of that money. But the deal with Microsoft doesn't share in any of that upside revenue. So certainly devil's in the detail. Microsoft not expecting to lose out, not expecting big revenue from AGI. And obviously the market's very, very split. Some oracles out there are saying that, AGI is a big concern and that AI is going to take over and wipe out the planet. Others say that it's never going to happen. So, we'll see. Certainly the build it and they will come philosophy that is supporting markets right now believes that AGI will be, that OpenAI will achieve AGI and they will be rewarded for it. So we'll have to wait and see. But for now, all we have is money being spent and promises. It's pretty much like a gold rush. There's AGI is like this huge gold vein that might be inside a mountain. And you found, a little bit of gold flakes outside in some of the streams, which is, AI or large language models. And so everyone is spending massively on picks and shovels to try and get into this mountain to get access to that big gold reef. But, we don't actually have any sonar and we don't have any ability to prove that reef is actually there. So you either, it's a bit of a gamble. Certainly, I think it's quite risky, but that's just my view. Renier says, do you think the AI boom could fund spending into global property, specifically helping the Sygnia Global Property ETF, as the performance has been lagging the market? Realistically, there surely should be more spending into data centers. You're spot on. So a growing portion of our global property 40 ETF is in data centers, and that is helping. But it's only it is a growing portion of that ETF, and it has been growing since COVID, which is good to see. Data warehouses and distribution centers, more defensive positions. So that does mean that the fundamentals of that property sector are good, but still being held back by rising interest rates at the moment. So probably a good long-term play if you believe in this AI rollout is going to happen over the next decade. And Manny says, so we must just look to profit from this then while it holds on. Yeah, Manny, I think that's spot on. I think the market right now is, as I said, terrified that there's going to be a correction, but even more terrified that they're going to miss out for another 6 or 12 months as the market could double because of this euphoria. So that's exactly it. Simonga says, no question, just saying that thank you for the webinars. Absolute pleasure. Thank you very much. Pleasure, Mr. Nika. What is his comment? Too many experts wanting Trump to fail just so they can look good. This phenomenon, wanting US president to fail, has only happened once before, Trump's first term. Certainly, Trump isn't winning any awards in terms of being loved. His approval ratings are the lowest of any incumbent president at this point in time. So it'll be interesting to see what happens at the midterms in a year from now, whether that continues. But I would have to say that as many people who hate Trump probably love Trump. It's a love-hate thing. And he's got some very loyal supporters. Yeah, it's it's difficult. I'm not going to say I want to see Trump fail. I'm certainly not in that camp. I just think that what he says is most often not what he does. So there is quite a big disconnect in terms of how he sells things. I mean, he's an amazing salesman, and all his policies he sells beautifully to his voters. It's just that how those policies actually impact the voters is quite different. But there's no doubt that the market is flying, and a lot of that is due to his policies, even if indirect. This huge growth we're seeing right now, it's deregulation, which is definitely one of Trump's policies, but it's also people spending ahead of tariffs, because they're terrified of tariffs, and so that's an indirect positive benefit of a negative policy. So just to and fro's. Charlie says, thanks for the presentation, pleasure. You mentioned the current pipeline of AI deals require equivalent of 26 nuclear power plants. Do you expect this trend to continue, and do you have any portfolios? We don't have any portfolios that directly benefit from either infrastructure plays. It is something that I was asked last month, and it is something we're looking into, either US energy infrastructure or commodities linked to that, like uranium miners. I mean, that 26 nuclear power plants, that was that was only on the $1 trillion spend. Now that we're up to $1.3 trillion, you're looking at even more nuclear power plants or other forms of energy that have to be spent. So there's definitely some demand there. Question is, will all that spending actually happen? It's hard to forecast a decade in advance. It's hard to know exactly what's going to happen in 10 years' time. We have been in a uranium bull before, late 2000s, and that didn't last as long as people were expecting. Peter says, is private equity going faster than public equity markets? About how much faster? Peter, it is. I don't know the exact numbers, but we've seen, we're currently in a huge boom in the markets. We're seeing companies that are loss-making have tripled over the last 6 months. So there is a Goldman Sachs non-profitable ETF, and that is up 300% over the last 6 months. So there's just huge demand for anything with growth. Now, what we're not seeing in this boom is a huge amount of IPOs, because the private sector is much bigger than it was before, and the private sector is just stealing the supply chain. So before the private equity or venture capital, they would exit by listing. Now they're exiting by starting a new fund and rolling that fund at higher prices, or rolling their holdings at higher prices into a new fund. So the private equity and venture capital are just actually eating up the supply chain. We're seeing fewer listings, and definitely the number of listed companies relative to the private equity sector is definitely shrinking. Which is why it is good that we have exposure to our OSE Bravos company, which gives us exposure to US and UK private equity, and performance on both US and UK have been phenomenal over the last 6 months. So that is great. That is the last question. So thank you very much to everybody who joined. And thank you for your time. Thank you for the questions. We have one more webinar on Tuesday, the 2nd of December. So it's the last webinar for the year. We will be taking a look back at what worked in 2025, but also looking at our forecast for 2026. So please join us next in the 2nd of December to see how we're positioning for 2026. And hopefully we'll also have some stock picks from the investment team in terms of what they think would be the best places globally and locally next year. Thanks a lot.